The stock market today, the biggest opportunity of the year, or a trap that could cost you everything. Imagine waking up tomorrow morning. You open your phone, check the stock market, and discover that billions of dollars have been wiped out overnight. Panic spreads across social media. Financial news channels flash breaking headlines. Some investors rush to sell everything they own. Others see the crash as the buying opportunity of a lifetime. But here's the question. If the market suddenly drops by 10, 15, or even 20%, would you know exactly what to do? Or would you react emotionally like millions of investors before you? History has taught us one powerful lesson. The biggest fortunes are rarely built during periods of excitement. They are built during periods of uncertainty. Every major stock market crash has created fear. Every recovery has rewarded patience. And every bull market has convinced people that prices could only go higher right before reality reminded everyone that markets move in cycles. Today, investors around the world are asking the same question. Is the current market setting up for another major rally? Or are we standing on the edge of a correction that few people see coming? The answer is not as simple as watching stock prices rise or fall. Behind every movement in the market lies a complex network of economic data, corporate earning, interest rate, inflation expectations, global events, and perhaps most importantly, human psychology. Because markets are not driven by numbers alone. They are driven by millions of emotional decisions made every single day. Fear, greed, hope, regret, confidence, panic. These emotions often move prices faster than financial statements ever could. That's why successful investors don't simply follow headlines. They learn to understand what is happening beneath the surface. In today's video, we'll break down the forces shaping today's stock market. We'll explore why volatility has increased, why some sectors continue attracting investors while others struggle, what risks deserve your attention, and how experienced investors prepare themselves regardless of whether the market goes up or down. This isn't about predicting tomorrow's closing price. No one can do that consistently. Instead, it's about understanding the bigger picture so that every investment decision is based on knowledge instead of emotion. Because in investing, the people who remain calm usually outperform the people who react first. So before you make your next investment decision, let's take a closer look at what is really happening inside today's stock market. What is really driving the market today? At first glance, today's stock market appears surprisingly resilient. Major indexes continue trading near historically elevated levels despite periods of sharp volatility. Some days, optimism pushes prices higher. The very next day, unexpected news can erase weeks of gains within hours. To many investors, this feels confusing. But beneath the daily price swing, several powerful forces are competing for control of the market. The first, and perhaps the most influential, is interest rate. Interest rates affect almost every part of the economy. When borrowing money becomes cheaper, businesses invest more. Consumers spend more. Corporate profits often improve. As confidence grows, investors become more willing to buy stocks. However, when interest rates remain high or begin rising again, everything changes. Companies face higher financing costs. Consumers become more cautious. Economic growth slows. And investors begin questioning whether stock prices still justify their valuations. This is why every speech from central banks attracts enormous attention from financial markets. Sometimes, a single sentence can move billions of dollars around the world. The second major driver is corporate earning. At the end of the day, stock prices cannot rise forever without businesses generating stronger profit. Investors closely examine quarterly earnings reports. Not only are they interested in how much money companies earned, they also care about future guidance. Is management optimistic? Are customers spending more? Are costs increasing? Will profits continue growing next quarter? Often, the future matters more than the present. A company can report record earnings and still see its stock price fall if investors believe growth is slowing. On the other hand, A company with average earnings may experience a significant rally simply because expectations for the future improve. This demonstrates an important truth. The market doesn't price today's reality. It prices tomorrow's expectations. Another major influence comes from inflation. Inflation affects purchasing power, consumer behavior, and business costs simultaneously. When inflation rises too quickly, companies may struggle with higher production expenses. Consumers reduce discretionary spending. Central banks may respond by tightening monetary policy. All of these factors create additional uncertainty for investors. Fortunately, markets generally perform best when inflation remains stable and predictable, not necessarily extremely low, but under control. Global events also continue shaping investor sentiment. Geopolitical tension, supply chain disruption, energy prices, international trade, currency fluctuation, political election. Every one of these factors has the potential to influence financial markets far beyond national borders. Today's stock market is more interconnected than ever before. A major economic event on one continent can trigger price movements thousands of miles away within seconds. Finally, there is one factor that often receives less attention than it deserves: investor psychology. Markets rarely move in perfectly rational ways. When optimism dominates, investors often believe that prices can only continue rising. Risk appears small. Confidence grows. People begin buying simply because others are buying. Eventually, expectations become unrealistic. Then comes a correction. Fear replaces confidence. Investors rush to sell. Good companies become undervalued simply because emotions temporarily overpower logic. This repeating cycle has existed for more than a century. Technology changes. Companies change. Economic conditions change. But human emotions remain remarkably consistent. Understanding this cycle may be one of the greatest advantages any long-term investor can possess. Because while nobody knows exactly what the market will do tomorrow, history consistently reminds us that emotional decisions are rarely the most profitable ones. The biggest risk, and where the real opportunities may be. Now that we understand what is driving today's stock market, the next question becomes even more important. Where are the biggest risks? And perhaps more importantly, where are the opportunities hiding? Many investors make the mistake of believing that risk only exists when the market is falling. In reality, risk can be even greater during periods of strong optimism. When stock prices climb rapidly for months, confidence begins to replace caution. Investors start believing that every dip is temporary. They assume the market will always recover quickly. Some begin borrowing money to increase their positions. Others stop paying attention to company fundamentals altogether. History shows that this is often when risk quietly builds beneath the surface. Markets rarely collapse without warning. Instead, they usually become increasingly expensive relative to corporate earnings. Valuations stretch higher. Expectations become unrealistic. Even excellent companies can become overpriced if investors are willing to pay almost any price for future growth. This doesn't necessarily mean a crash is imminent, but it does mean future returns may become more difficult to achieve. One of the biggest risks investors face today is chasing momentum. It's easy to feel confident when a stock has doubled over the past year. News headlines celebrate its success. Social media is filled with stories of quick profit. Friends and coworkers begin talking about how much money they've made. At that point, many people decide to invest. Ironically, they often enter after most of the gains have already occurred. Professional investors understand something important. Great companies are not always great investments. Price matters. Buying an outstanding business at an unreasonable valuation can still produce disappointing long-term return. Another significant risk comes from concentration. Some investors place nearly all of their capital into one company, one sector, or one investment theme. If that sector performs well, returns can be impressive. But if conditions suddenly change, losses can become severe. Diversification isn't designed to maximize returns in the short term. It's designed to protect investors from being wrong. And every investor, no matter how experienced, will eventually be wrong. The question isn't whether mistakes will happen. The question is whether your portfolio can survive them. Economic uncertainty also remains an important consideration. Inflation may improve for several months before unexpectedly rising again. Interest rates can remain higher for longer than markets anticipate. Consumer spending may weaken. Corporate profits may slow. International conflicts can disrupt global trade. Unexpected political decisions can create volatility overnight. These events are impossible to predict with complete accuracy. That's why successful investors prepare for uncertainty instead of trying to eliminate it. Preparation always beats prediction. Now let's talk about opportunities. Despite the risk, every period of uncertainty creates new possibility. In fact, some of history's greatest investment opportunities emerged during moments when fear dominated financial markets. When prices fall sharply, investors often sell both weak companies and strong companies together. This creates opportunities for disciplined investors willing to look beyond short-term headlines. Instead of asking, which stock will double next month, experienced investors ask, which businesses are likely to remain stronger 5 or 10 years from now. This simple shift in thinking changes everything. Rather than focusing on daily price movement, they focus on business quality. They evaluate revenue growth, profit margins, cash flow, competitive advantages, debt levels, management quality, innovation, market leadership, customer loyalty. These factors determine whether a company can continue creating value over many years. Another opportunity lies in patience. Patience sounds simple, yet it may be one of the rarest qualities in today's financial markets. Modern technology allows investors to buy and sell within seconds. News travels instantly. Prices update continuously. This constant flow of information creates the illusion that action is always required. But often, doing nothing is the most intelligent decision. Legendary investors have repeatedly emphasized that wealth is frequently created not through constant trading, but through allowing exceptional businesses enough time to grow. Compounding requires time. A company that grows earnings consistently year after year doesn't need spectacular short-term price movements to reward shareholders. Its long-term performance can become extraordinary simply through steady progress. One overlooked opportunity during uncertain markets is maintaining cash reserves. Some people think holding cash means missing opportunity. In reality, cash provides flexibility. It allows investors to act when attractive opportunities appear. Without available capital, even the best investment idea cannot be purchased. Cash also reduces emotional pressure. Investors who are fully invested often feel trapped during market decline. Those with available cash can remain calm and even welcome lower prices. Perhaps the greatest opportunity of all is education. Markets constantly evolve. New industries emerge. Technology transforms entire sectors. Economic conditions change. But investors who continue learning gain an advantage that compounds over time. Reading financial reports, studying economic trends, understanding business models, learning from both successful and unsuccessful investments. These habits may not produce immediate profits, but over years and decades, they can dramatically improve decision-making. The stock market has always rewarded knowledge, discipline, and patience far more consistently than excitement or speculation. Ultimately, today's market presents both opportunity and risk. The challenge is not choosing one or the other. The challenge is recognizing that they always exist together. Every investment carries uncertainty. Every market cycle creates winners and losers. And every investor must decide whether to follow emotion or follow a well-designed strategy. Because in the end, successful investing isn't about being right every single time. It's about making decisions that remain intelligent across many different market conditions. The mindset that separates successful investors from everyone else. So, after looking at today's market from every angle, one final question remains. What should investors actually do next? The truth is, there is no perfect answer. No analyst, economist, financial institution, or investment expert can predict the stock market with complete accuracy. Every year, forecasts are made. Some turn out to be correct. Many do not. Markets are influenced by countless variables that no one can fully control: economic data, corporate earnings, geopolitical events, technological breakthroughs, consumer behavior, and, perhaps most unpredictably, human emotion. This is why the most successful investors rarely focus on predicting the future. Instead, they focus on preparing for it. Preparation is a strategy. Prediction is a guess. And history has consistently rewarded preparation far more than speculation. One of the most valuable habits an investor can develop is consistency. Rather than trying to buy at the exact bottom or sell at the exact top, disciplined investors build positions gradually over time. They understand that timing the market perfectly is nearly impossible. But participating in the market consistently has historically produced far better long-term results than waiting endlessly for the perfect moment. Another essential principle is risk management. Many people spend all of their energy thinking about how much money they can make. Very few spend enough time thinking about how much they could lose. Yet protecting capital is often more important than chasing extraordinary returns. Imagine two investors. The first earns 50% one year but loses 50% the next. The second earns a steady 10 to 12% annually for many years. At first glance, the first investor appears more successful. But over time, the second investor often builds far greater wealth through the power of consistency and compounding. This illustrates one of the greatest lessons in investing. You don't need to hit home runs every year. You simply need to avoid major mistakes. Because recovering from large losses becomes increasingly difficult. A portfolio that falls by 50% must gain 100% just to return to its original value. That is why experienced investors place such a strong emphasis on protecting downside risk. They diversify. They avoid excessive leverage. They remain patient during periods of market euphoria. And they resist making emotional decisions during market downturns. Perhaps the greatest competitive advantage any investor can have today isn't access to better information. Information is everywhere. Financial news is available 24 hours a day. Corporate earnings reports are public. Economic data is released to everyone at the same time. The real advantage lies in interpretation. Successful investors ask different questions. Instead of asking, "How much money can I make this month?" they ask, "Will this investment still make sense 5 years from now?" Instead of reacting to every headline, they focus on the underlying business. Instead of chasing the hottest trend, they search for sustainable value. This mindset creates discipline. And discipline creates consistency. It's also important to remember that investing is a marathon, not a sprint. The wealthiest long-term investors did not become successful because they made one lucky trade. They became successful because they followed a process, year after year, through bull market, bear market, recessions, recoveries, and everything in between. They accepted that volatility is normal. Market corrections are normal. Periods of uncertainty are normal. These events are not signs that investing has failed. They are simply part of the journey. In fact, volatility often creates the very opportunities that long-term investors are waiting for. When fear dominates the market, quality businesses can temporarily trade far below their intrinsic value. For investors with patience and a long-term perspective, these moments can become some of the most rewarding. Of course, this does not mean every decline should be bought. Careful research always matters. Financial discipline always matters. Understanding what you own and why you own it always matters. Successful investing is never about blindly following trends. It is about making informed decisions based on evidence, valuation, and long-term conviction. As you continue your investment journey, remember this simple idea. Markets will always fluctuate. Headlines will always change. Experts will always disagree. But the principles of successful investing have remained remarkably consistent for generations. Stay informed. Stay disciplined. Stay diversified. Continue learning. Control your emotion. And never stop thinking long-term. Because while no one can control the market, everyone can control how they respond to it. And in the end, the response may determine the difference between short-term frustration and long-term financial success. If you found this analysis helpful, consider subscribing to the channel for more in-depth insights into the stock market, investing strategies, and the global economy. Every week, we'll break down the biggest financial stories, explain what they mean for investors, and help you make smarter, more informed decisions in an ever-changing market. Thank you for watching. Stay patient, stay disciplined, and we'll see you in the next video.